watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Ricus from PSG, Hole-in-One, Ruimsig, and Gary Booysen from Rand Swiss. Be sure to send questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using the hashtag Stockwatch. Gents, appreciate the time today. A quietish week on the JSE, although the rest of the world is trading out great guns. Ricus, let's start with you. I wanted to have a bit of a big picture on the Magnificent Seven. Obviously, they had we had the bear market through to around 2022, early 23. They absolutely stormed ahead. They've been sold off in the last couple of months. Are there any of those seven that you are looking at and thinking, this starts to get quite juicy?
Yeah, I think I almost want to stop referring to them as the Mag 7 because their performance of the last 2-3 months has been so desperate. From Tesla and and a huge retraction to sort of Google, which is back at sort of possibly sensible levels. Well, Alphabet at sensible levels, and things like Apple still looking expensive. But on the face of it, if you believe that the worst is over after the first 100 days of Trump's chaos, some of them are possibly at viable levels, but at the moment I don't trust that yet, and that's just my personal viewpoint. But I would certainly be looking at things, as I said, like, for example, Alphabet, and I made a couple of notes here, which have obviously just gone passed away. But if some of these are below historic 20 and forward price earnings also below 20, which price levels they haven't seen in years.
Yeah, no, I take your point. Gary, one of the Mag 7 is your stock pick. So aside from that one, the other 6 that are out there, I mean, they are tech. They are going to be around for a while. We are 100 days into Trump's presidency. It has been a wild ride in many ways. Are you looking at the other 6 and giving thought to them?
No, absolutely. I think definitely, because we're invested in a lot of them, and I think we've been adding fairly aggressively to it as well. So Michael Hartnett was actually the person that coined the term the Magnificent Seven, and he came out at the beginning of the year and said you should change that to the Lagnificent Seven because these things have run a little bit too hard and they're going to struggle for a while. But I think it really depends on your outlook when you're buying into one of these stocks as well. And if you do have a long-term view, it's very difficult to see how the Magnificent Seven don't continue to dominate over the next 10 years. A lot of people look at them as racy tech stocks, low interest rates, they shoot the lights out. These have enormous cash piles. They are absolutely entrenched in the daily lives of so many of the global population that it's very difficult to see a world where these are not still successful companies. And as Ricus said earlier, you look at something like Alphabet, you look at a lot of these stocks and they suddenly are looking at a lot more reasonable valuations. And people that were chewing our arm off to buy into them, towards the end of December, telling us how we should just have more of it, now suddenly, because they've dropped a little bit, are saying, oh, well, tariffs are going to impact regulatory changes are going to impact them. Of course, that's always been a risk for these businesses, but they are so fundamental to I think the way that the world is changing. It's difficult to see how a portfolio succeeds without them. I mean, you look at the developments in AI at the moment across ChatGPT and the Gemini and all the other models as well. I mean, these companies are absolutely geared to succeed because of that. So I honestly don't know how you build a portfolio without them at this stage. It's too important. It's too important a theme.
Yeah, I take your point, and then you talk around they're part of our lives. I mean, just running down some of them that have got billion-plus users, Microsoft, Alphabet. I think Alphabet's probably got 3 in there. Meta's got 3. Apple, Amazon. I mean, billion-plus is a staggering number. They're not going away. To change track slightly, but not completely, but oil, and Brent is the one I focus on. I pull up a 1-year chart. It's down just over 23% over the last year, trading in the low 60s. Gary, I mean, this continues to tell us a story, and that story is quite simple, that there's too much supply and or not enough demand. And I mean, it's great for our petrol price, but it is telling us a bit of a global economy story, or is it too much supply coming into the market and less around the demand story?
Well, I think it's maybe not the demand right now because we've had a little bit of stockpiling ahead of the tariffs, and you've almost seen like this flurry of economic activity. But it's the outlook for what the demand is going to be, and I suppose comparing that outlook to the outlook that OPEC is putting up, and right now, I mean, the demand story, the flagging demand story is clear. Trade wars will mean less trade. It means lower growth. And the world needs to kind of adjust to this. At the same time, you look at where the OPEC forecasts are. So if you look at their April OPEC report, they're looking at global growth. They say, yes, we've moderated our global growth outlook. We think that the world is going to grow at 3%. I mean, if you even take the World Bank and IMF value, so I mean, World Bank's at 2.7%, IMF's at about 2.8. Still, OPEC is above that, even with discounting. And I think there's many banks that are coming in and saying, wait a minute, there's going to be a recession. And it's clear that OPEC wants to pump. I mean, they've got their meeting coming up on the 5th of May, and yeah, they want to open the taps. They want they want to sell product at this stage. So yeah, I think it's a difficult place for you're kind of caught between weaker demand and increasing supply, and it's difficult how you see a recovery back to, let's say, $100 a barrel without a significant supply shock or a major change in the policy outlook that we've seen so far this year.
Yeah, and I take your point. If you're an OPEC producer, lower price, you want to pump oil because you just want to get more revenue in. Ricus, of course, oil week plays directly into Sasol. I have to say, the questions coming through on this show around Sasol have kind of dried up sort of sub 100. I know you've traded it a few times, but with oil looking weak, it doesn't bode well for Sasol at all, surely. I mean, they've got a lot of chemicals, but chemicals aren't exactly rebounding yet either.
Yeah, I'm more worried chemical prices getting a softer world economy or possibly even a soft American recession than I am about oil. Um, so, and none of those two factors are looking good for Sasol. And as I've said, if you want to go into a chemical or Sasol or I mean a chemical or an oil company, I mean go and take a look elsewhere for that kind of thing offshore. You don't want to be sitting with a company that's struggling both as a result of the prices of the product they sell plus the operational difficulties that they're having.
Yeah, absolutely. Yeah, no fun there whatsoever. Let's come to some company numbers. We have got some news in the JSE. Ricus, yesterday we had a We Buy Cars update. Core HEPS essentially flat, 0 to 4% up. CMH under a fair bit of pressure. Revenue was okay, but earnings wasn't. Dividend down. Obviously, different sides of the business. We Buy Cars, all about second-hand. CMH, mostly new vehicles, some car hire, a bit of second-hand, but not much. Are either of them attractive to you from a South African investment perspective?
Well, I think, as you said, it's two sides of the market, and for me, the crux of the matter is that the CMH has got to adjust to the changing South African motor market as people buy less of, let's say, their the classic BMW, Audi, that kind of thing, and move to cheaper imports, which means that CMH has got to adapt to that market, whereas We Buy Cars is just a conduit for that market. They don't have to adapt anything. It just depends on what lands on their showroom and what they sell. So it's far easier for them to generate revenue and income than it is for CMH, which effectively have got to change their business model to a certain extent.
On the We Buy Cars, Rick is staying with you. I mean, a forward PE, if you annualize the trading update, forward PE, I don't know, high teens, is that an attractive price point, or is that perhaps this is sort of a maturing business? They do promise market share gains, although we always need to see that play out over the next couple of years.
Is that for We Buy Cars?
Yeah.
Yeah, I don't think it's I think it's a reasonable valuation, but as I mentioned, because it's big about a week or so ago, I really think that there's not only locally but globally because of supply chain problems. Your second-hand market and for cars as well are looking increasingly attractive. We've already seen the run in, for example, US and also Euro companies which are involved in the second-hand market. And We Buy Cars is a perfect example of something that is available locally.
Gary, We Buy Cars, CMH, either of them on your shopping list? As Ricus says, distinctly different. Your take on the two, would you be looking at either or neither?
So it's a difficult question, because if you look at it, the whole industry is in an enormous amount of flux. If I had to pick one, I would probably go with We Buy Cars and pay up. And I think 17 is fair to full at this stage. But if you could get it on kind of like a 14, 15, I think then you're looking pretty good. But wait for a little bit of volatility to get in or out. And the reason for it, though, is that these are quite speculative in nature at this stage, because of the changes that we're seeing in the motor vehicle industry. We've got full self-driving coming in. We'll talk about that a bit later. In terms of Waymo, you've got all these. The whole industry is just in a lot of flux. I mean, you've got the likes of Uber. Are people going to buy cars? Are they going to rent cars instead? I mean, I suppose the cars still have to be sold, but are they going to be sold through CMH dealerships? How does it's changing? I mean, we've got the electrification as well. We've got the likes of Volvo, focusing on EVs, and CMH has had to pull back, dramatically on the dealerships that can sell its products. So there's a lot of strategic changes for the companies, which makes it a very speculative industry for me. We Buy Cars, I probably would lean towards that, because it's a platform model.
Yeah.
Rather than, and essentially, as Ricus was pointing out, they are largely immune to these kind of shifts, because as long as people are buying and selling assets that move them around, whether they're electric, whether you're an Uber driver that needs to get a car, maybe you're going to use We Buy Cars, the platform works. I think that the challenge for We Buy Cars, though, is to take market share, and they are operating in an economy that is quite stagnant. And if you are going to buy We Buy Cars, you have to have a pretty solid view that the South African economy is going to improve dramatically, which of course it can. But right now, I think you've got around 10 million South Africans that can afford to buy cars. We're a population of 70 million at the moment. If we do see an uplift in wealth in South Africa, there's a lot of untapped potential, but that's got to happen first. You've got to have a reasonable expectation that that's going to happen in the short to medium term.
Yeah, and the CMH results specifically mention as well, we're keeping our cars a whole lot longer, which has implications. Let's head a short break. Keep those questions coming. Email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. We'll get right back after this.